Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, as the Dow logged in its sixth straight positive week, the head of the New York Stock Exchange says it's traders, not investors, who are fueling this rally. But do our panelists agree? We'll find out. From Editor-at-Large Steve Reitmeister, Senior Market Analyst Charles Rotblatt, and, of course, top market technician Kevin Matris here at the round table. So, do you guys agree with that? I mean, what is this guy, trying to take all the wind out of everybody's sails? You know, and there is the one argument out there in a story that I saw that this man, being head of the New York Stock Exchange, does have access to statistics, trading statistics that others don't have. So I don't know, Kevin.
He's got a point. I think that you've seen a lot of traders coming into the market over the last, 5-6 weeks looking for deals. These are short-term traders trying to be able to profit on this rebound. But don't get me wrong. I mean, I think you have had a lot of regular investors getting in. The problem is that it just hasn't been at the magnitude that we have seen before. So you do have institutional investors getting in, but they're not all getting in. There's still a tremendous amount of cash on the side. And what's interesting is that I even wrote an article on it several weeks ago. As the market has been going higher, what was almost astounding is that you started to see the volume kind of go down, and that should not happen. So if you see volume starting to wane as the market continues to build on its gains, that shows a lack of participation or a degree of skepticism. And I think that there has been a tremendous amount of skepticism that has accompanied this rally. So I think there should be a correction coming pretty soon. We're seeing that happen right now. Do I think we're going to be, making brand new lows, taking out the March lows that we have seen? Nobody really knows. But in regard to individual stocks, I think that there are many stocks that have put in generational lows. And I do think that there has been some good investor participation. But you need to see institutional investors and the retail investors come back en masse in order for this rally to build upon itself and create that second leg where everybody will believe it.
Well, but then maybe that, what you just said, strengthens this man's argument, Charles, because the NYSE head says that real investors are institutional investors who commit large quantities of cash to the market for longer terms.
Well, I'm not saying the data that he's looking at either, and so it's hard to say whether or not he's kind of opinionating this is what's happening or if he's actually basing it on real data. But I think you're probably seeing a mix. Certainly when you look at the banking stocks and how far they've risen in such a short period of time. I've said this before, they're trading surely off speculation and sentiment. There's no technical fundamental analysis going on here. I do think when you look at some companies, though, I think some investors are probably stepping back, realizing this company is not going out of business. You could maybe talk about Goldman Sachs, or maybe you could to Best Buy, or there's probably 100 other examples I could give where people are looking at it and saying, this company's been beat at pretty bad valuation. I think the long-term future is still pretty good. So you probably are seeing some long-term investors getting in there. But I do think there's a lot of people that are worried. We're still in the midst of a recession. We still have the questions about the banks and what the stress tests are going to bring out. And more importantly, what's the government's exit strategy out of TARP? I have no idea. Nobody else does. Mm-hmm. And then you're also looking at General Motors going out there and whether or not they'll file for bankruptcy. So there's some legitimate fears, but I do think at the end of the day it's probably a mix. Some investors, but also a lot of traders chasing momentum.
I guess there's always somebody trying to throw a wet blanket on everything, isn't there?
Yeah, no, I mean, I don't think it really matters if it's just traders or just investors. I mean, the thing that goes along with the trader story is if you take a look at the daily constant rotation of what groups are in favor and what groups are out of favor. It's almost like they're flip-flopping every day, the biggest winners, the biggest losers, and the next day they're just changing places. So that would make me think that it is a lot of traders. But heck, going back to October, you had Warren Buffett, the world's greatest investor, saying that he was getting in the market and he just felt that he didn't know what was going to happen next 3, 6 months, even a year, but he just felt that it was a great buying opportunity. So that's the world's greatest investor who jumped in, and we can make fun of him for getting in a little bit early. But what he was doing was he was looking past the horizon, past of where some bottom was, and saying, these are good enough values for right now. And I think there's enough folks out there seeing just a sprinkle of better news, not good news, but better news or not as horrible news that has investors thinking, you know what, we may have bottomed, we may not, but this is not a bad enough time. And so it may be fueled, the speed at which the rally took place might have been fueled by traders, but I think there's plenty of investors that are getting on board. Yeah.
One thing, Charles, is that there seems to be a feeling on the street that it's not the earnings that have been the spark that ignited this latest rally in the stock market.
Well, I think there actually was an expectation heading into earnings season that there would be good numbers, particularly with the banks. A lot of banks came out in February and March and said, hey, we're borrowing at zero, and guess what? We're going to have great profits if you exclude our bad debt.
Right. Don't do that, Ian. You shook Steve up when you did that. I saw him. He just looked right there.
Trying to use some of Steve's energy there. Yeah. But you know what? If I can borrow at zero and lend at 7 or 17, I can make money. A 3-year-old can make money like that.
Well, this week we'll see if the proof is in that pudding because a lot of bank stocks are reporting this
Right,
week.
but we've already had some good numbers. Bank of America out this morning. We had some numbers last week. So they are making money based on this adjusted scenario. But I think there was an expectation going into earnings season that numbers would not be as bad as feared. We've seen several companies up to this point coming out either with guidance or actual earnings with numbers that are better than feared. And I think that's a key phrase, better than feared. Not necessarily good, not great, but for a lot of companies, relative to expectations, they're beating it. But I think there was an expectation that we would see that. And as a result, when you look at some of the bigger issues going past earnings season, I think people are trying to focus more on those than actual earnings. I think really the only way earnings would truly move the markets is if they were absolutely horrible and just beyond belief in terms of how bad they were. We're not seeing that. Hence, we're not seeing a great reaction to earnings in general.
So, Kevin, do you think that in the midst of all of the positive market sentiment, earnings proved to be an obstacle or not?
It's interesting. You take a look at the earnings from these banks, and like Charles had said, it's hardly a genius business model, getting money at zero and then loaning it out at 4.5. But think about it. You've had a lot of these financial stocks go up 20, 30, 40%. So if you've got a not bad number, not good, but a not bad number, and you're here, but now all of a sudden the stocks are here and you're still coming out with these not bad numbers, they're more impactful when the market has been beaten down, less impactful when the market has already gone up. What I do think, though, is that there have been some bright spots out of earnings. You take a look at the retail sector. I believe those earnings have sparked a rally. Again, they haven't been spectacular, but they have probably been one of the better bunches. But I think a lot of people are concerned about downside risk. The thing that I think freaked everybody out last week was Burger King. Everybody thought that McDonald's and these fast food restaurants were going to do great, and everybody was starting to buy these things up. And then Burger King reports crummy numbers saying that reduced traffic has really hurt them, and that has gotten pummeled. So I think people are really looking at earnings quality. Another example is Intel. Intel actually came out with decent numbers, but when you start really looking at their numbers, you start finding these one-off situations, and I believe that not only for those kinds of companies, but all of the companies that are going to be reporting this week, there's like 900 companies, another 800 next week, people are going to be looking at these numbers and looking at the quality of these earnings. And I think the other thing that has people a little bit concerned is that there is a significant number of companies that have refused to offer guidance because they don't know. And if they don't know, should investors feel comfortable, right?
Yeah.
So.
Well, I think Kevin makes a good point because whether they spark the rally or not, still all eyes remain on earnings.
All eyes remain on earnings because that's how you value companies, that we keep repeating here. What we have to remember is that earnings season doesn't start with the first earnings report from Alcoa. It starts a couple weeks before that in what we call pre-announcement season. There was virtually no pre-announcements. I mean, have you ever heard a quieter period? And that spoke volumes. So the market rallied with the lack of pre-announcements. And so now that it's kind of, stalling out or pausing right here, it's not because the earnings reports are bad, it's because there was a lack of bad news that said, nobody's putting out the red flag right now. great, we can rally up, and now the reports are about in line with the expectations when there was so few pre-announcements. Right. I don't find that terribly shocking. In terms of what should investors expect going forward, there's a very good point here about what's the future guidance. A lot of these folks are a lot more mum about it. We talked about that last week. Mm-hmm. It's still dicey out there in that they don't CEOs don't want to be caught off guard with making too bullish statements, and so they're just kind of being mum about it. And some people are taking that as a negative. I would take that as being realistic, okay? No one wants to get out too much on a limb. They're reporting decent numbers. There was very few pre-announcements. The market is digesting what's going on. The rate of analyst positive revisions is slightly increasing over the past, which not great, okay, but better, okay? And so there are some positive things to hold on to here.
All right, well, that's the latest thinking of our crew. From the round table with everyone here, I'm Terry Ruffalo.